We have Mr. Nikhil Sawhney, who is ready to talk to us about Triveni turbines because things have been looking up there as well. We have seen the 9-month earnings, and of course, we have seen how their overall revenue has jumped up by 36%, and a lot of it has been driven by exports. Nikhil, hi, good to be speaking with you. Good morning. I just wanted to begin by discussing the export side of the business because that is what has been the kicker for you. Going forward, what kind of contribution do you expect from there? Because that's the area which has been increasing.
Well, firstly, very good morning to you, and thank you for having me on. Yes, you rightly point out that exports is a growth area for the business, and it's largely driven by the fact that we have lower visibility in the export market, and so we have more room to grow. The market in India operates largely in a duopolistic manner, and so where we respond to both fixed capital formation as well as other sources of demand in the domestic economy. And so we really can't create the demand. While on the export side, there's more uncaptured market for us. And so that will be a growth driver, as you have seen and as you have pointed out in our order booking, which will translate into revenues in the quarters and years to come. So from an operational perspective, also, we are gearing up for that, not only in terms of being able to be closer to the customer, which gives them more confidence in the international market by setting up servicing offerings, but also by hiring in the international markets.
But I think the overall contribution of exports right now is 53%. What do you think it can scale up to? And secondly, help me understand, what's the margin differential between, let's say, an export order versus a domestic order?
Well, the export orders, of course, as you would understand, we have an installed base in over 80 countries globally and an inquiry book for over 110 different countries. And the nature of the product is that it's customized. But to generalize it, yes, export orders are significantly better than they are in the domestic market. The domestic market is the most competitive market that we see globally. And that's something that's good. We don't shy away from that. For us to maintain our good market share in India, it allows us to have good supply chain visibility and cost savings. But as we look at it going forward, the potential for growth in the export market would be driven by two different distinct business verticals, which is selling of the product as well as servicing and aftermarket. Aftermarket is also has a business stream where we do third-party services, and that's an area which will grow significantly internationally as well, as it allows us to be present in international markets where we do not have an adequate installed base, but would be able to service third-party turbine and rotating equipment users. And so as we look at it going forward, our order book, as you rightly pointed out, has grown in excess of 28% in this last 9 months. And we have a book and bill which comes in the first quarter or so. So maintaining the growth that we've had in the last couple of years for the next couple of years seems to be something that we are quite confident on. It's driven purely by the fact that we have relevant products in a relevant market. As if I could tell you about what are the drivers for those growth, principally in the export market, it's driven around renewable energy power production, which stems from energy efficiency at one end, as well as biomass or waste to energy-based projects. It's also partly driven by fixed capital formation happening in certain industries. As you know, we're in an inflationary time where commodities have certain pricing power. And with that comes the demand for enhancing capacity of these commodity producers. And so we see demand stretching everywhere from metals and steel to cement to process cogeneration, including food, pharmaceuticals, etc.
Right. Nikhil, just wanted to understand what's happening with the North America subsidiary. What kind of order inflows are you seeing right now? And how do you think this particular unit is going to contribute to your overall revenue pie in, say, the next 6 to 8 months?
Well, 6 to 8 months is quite a short time period, but the board announced that we would be setting up the subsidiary in its last board meeting. So this is something that is already underway, and we believe that establishing the subsidiary is a very short-term project, but essentially to scale the business, which is not only to build out the infrastructure, but to hire the people who would be able to contribute into that that particular entity, is something that we would look for really to start contributing from next year, FY25 onwards. Even though FY24, we do have certain low-hanging fruit that we will be attacking. The main reason behind this is we see an increased willingness for the American industrial consumer to invest into energy efficiency. Energy costs in the United States have been extremely low. And as we look at the variety of different incentive schemes, be it the Inflation Reduction Act or a variety of different acts which incentivize energy efficiency, we see an increased appetite for customers stretching everywhere from oil and gas to more on the renewable side as well, to invest further into this heat and power solution, which is what we provide.
Give me some color on what the order inflow trends are looking like across the board.
Well, in this past quarter, actually, it was a record quarter in a number of manners for us. We achieved our highest order booking, our highest revenue, and our highest EBITDA ever. And we aim to actually grow that in the quarters to come. We haven't given any specific guidance to our investors or to the stock exchange, but suffice to say that as a capital goods manufacturer, our order booking is subject to the visibility that we have in the market, which is driven by our inquiry flow. And our inquiry flow has been quite resilient. In the 9-month period, it's increased by in excess of about 20-25%. So that gives us a very large market to attack in the short term. And so we believe maintaining this growth is something that we're quite confident on.
Maintaining the growth, and you're quite confident about it, at least for the very near to medium term. But Nikhil, what about the margins? They're already close to around 23%. Do you see more scope of an improvement there as well?
I think that's a question that our investors have brought up as well. Suffice to say, as we get some operating leverage on the business, there is room for margins to expand. More than that, the exports as a percentage of sales should rise, which gives us less pressure on margins. But having said that, we've cautioned our investors that we're happy with the margin levels that we're at right now, where it allows us more room to grow quicker than to constrain ourselves on margins. And we also do see the fact that the business will be investing significantly in people. And people do pay off in the quarters and years to come. They don't pay off immediately. To give you an idea, the company grew its workforce by about 20% in FY23. In FY24, we will be growing it by about 15%. And our ambition is to grow it by another 20% in FY25. And so all of this, these are all costs at the end of the day. And getting the right talent is something that is very important for the company as we see it along the entire value chain. We need it in every form, but essentially it would be geared much more, as I pointed out earlier, towards our export growth.
For export growth and making investments in the talent as well. Thanks, Nikhil, for making time and speaking with us. Always a pleasure.
Thank you very much.